we are getting more value with the longer this buyback program goes on for. Hey everyone, so if you are new to my channel, well, welcome aboard. What I try to do here on the channel is explain that investing in the stock market is more than just buying a company you love and that's it, and thinking it's going up forever. There are a lot of people who are going to get crushed by this mentality, and I'm trying to help you avoid it. My strategy is to look at an investment based on its financials, just like we would if we wanted to buy an entire company and run it ourselves. Just follow along to learn how to do this yourself, plus we will have a target buy price by the end of the video. Look, it's part art and part science anyway, but the more practice we do, the better we're going to get. So obviously by the title of this video, we're looking at LAM Research, and we're going to do a quick valuation through my 9-point checklist, and then I'll give you my opinion at the end. So let's talk about what LAM Research actually is. So I would explain it as like a picks and shovels business of the semiconductor industry. They provide a lot of the wafer machines and equipment that's needed to make the microchips and processors and stuff like that. It's an $86 billion market cap company, so it's already pretty big. All right, let's just get straight into the financials and see whether it's worth investigating further. So the first thing we want to look for is revenue growth. This is really important. And to see that, we have gone from 2012 at about 2 billion to 3 billion to now being around about 14 billion. So yeah, that's significant revenue growth. Fantastic. Okay, good start. Gross margins. Now, gross margins have been, we want to see this above 40% and hopefully growing. If it's growing, it means it does have a competitive advantage. It means they're being able to raise prices or be a little bit more efficient in what they do. Because if they were lowering their prices, it means that competition are eating away at their profitability. But gross margins are really stable. Actually, they're sitting around 46% now for the last 5 or 6 years. Cool. All right. It's actually been growing a little bit, if anything. So we can definitely give that a tick for gross margins. Good start. Return on invested capital. How good is the management team at investing the money that they make into the business to grow the business further for the next year? Now, return on invested capital, I want this above, anything above 10, 15%. That range is a pretty good number. The higher, the better. Now, it was sort of low, 7 or 8 years ago, like single digits low. But for the last 5 years, they've really obviously turned a corner here and become a lot better at investing their capital. At the moment, it looks like it's around about 37% for the previous year. So that's fantastic return on invested capital numbers. Yeah, really strong. That's really good to see. Okay, we can give that a tick. And the next thing we're going to look at is the debt. Now, debt is the number one reason a company will get into trouble. So what we're going to do is we're looking at their short-term debt, which they have $11 billion of assets compared to $3 billion in liabilities. They can easily cover that, no problem at all. They've actually got enough current assets to cover both their long-term liabilities and their short-term liabilities. They are in a very strong balance sheet position. So that's a strong tick for the debt. Next number is free cash flow. Free cash flow is essentially the amount of money that we will sort of get as the investors in the company itself. So the management team will decide what to do with this free cash flow. They'll give it to us as dividends, or they'll buy back shares, or pay down debt, or they'll do something with it to return value to us as shareholders. But free cash flow is essentially the money that's for us. Now, we want to see this growing if possible, and it has. It's been growing just like the revenue's growing. So from $500 million to a little over 3 billion now, that's fantastic over the last 7 or 8 years. We can give that a tick as well. Okay, now moving on to the brokerage accounts that I use. Now I use Interactive Brokers and Saxo Bank. I have links in the description if you're interested. Now I think they're really important to have. It's really important to have good brokerage accounts because things like Robinhood and stuff like that, look, I don't think they have a long enough history. They don't give you access to international markets. Yeah, their fees are low, but I don't know. I'm not a fan of these apps. I want to use a company that's been around for a long period of time, and that's what Interactive Brokers and Saxo Bank are. I think we take enough risk with our investments already. I don't need any more risk involved with my brokerage account. So I take the safest option. Okay, the next numbers we're going to be looking at are the shares outstanding. So if shares outstanding are getting bigger, that's a problem. It means we're getting diluted. If the shares are staying the same, or hopefully they're getting lower, it means the value of our shares are hopefully getting bigger. So let's take a look at the share count, and it has been declining pretty rapidly. So in 2017, there was 184 million. Now it's only 145 million. That's a pretty aggressive share buyback program they're running here. So yeah, really, the value of our shares are getting stronger. That's really good news. So we can probably increase the growth rate when we do our valuation. I will increase it a little bit more because of this aggressive buyback program, because we are getting more value with the longer this buyback program goes on for. Now, insider ownership, what I'm looking for here is the incentives of the management team to be aligned with us. So I want, say, their salary to be quite insignificant compared to the amount of shares that they have. Therefore, the performance of the share price is more important than their own salary. Therefore, they hopefully are thinking about the company and its longevity so they make more money. I think that makes sense. All right, so we look at the leadership team. We've got Timothy Archer, Douglas Bettinger, and they own, looks like about 50 million or so in shares. Their compensation is definitely lower than that. It's not the best I've ever seen, the relationship between their compensation and their ownership, but it's still pretty strong. $50 million compared to $5 and $10 million of salary. It's definitely more important for the share price to improve than their salary. So I'm happy with that. We can give that a tick too. Now, the next thing I want to look for are whether there's actually some super investors already invested in this company. And the reason I do this is because I'm not that smart, and the super investors have been doing this for decades, like the Warren Buffetts and the Charlie Mungers and stuff like that. They've been doing it for so long that they're so much better at it than me, and it helps me be less of an idiot and making bad decisions if I have somebody who is better than this than me already invested in the company. It would give me a lot more conviction. Unfortunately for LAM Research, I couldn't find any gurus that have invested in this company, so I have to give them a cross. But if you do know of anybody, I've been trying to find somebody invested in this company, but I couldn't find anyone. So if you know of anybody, please leave it in the comments and I can change my opinion on this section. But I couldn't find any, so I'm gonna have to give that a cross. Okay, the most important thing that we now need to do is look at the price. So the price is just by far the most important thing. No matter how good this company is, which it is, it's a really good company. It's passed all my financial metrics so far. The price that we pay is the most important thing, because if we're overpaying, we're going to get a poor return on our investment. If we're getting a cheap price, we're going to get a far superior return on investment and for a long period of time. So to do that, I go to my intrinsic value calculator, and it's free and it's in the description if you want a copy for yourself. Now, I've used analyst growth rates of 12 and 10% for the next sort of 5 and 10 year period, but I'm going to increase that a little bit because of the share buyback program that's happening. I'm going to give them an extra 3% for the next 5 years, just because they've been doing a great job buying back shares. After that, it gets a bit harder to understand the growth rate, so I'm just going to put that down at 10%. Now, my return on investment goal, I'm aiming for 30%. Now, I know that's insane. No one does this in their discounted cash flow models, but I do, because I'm actually aiming for somewhere in the 20% range. So I aim for 30. And if I'm not quite right with some of these things, and maybe the company doesn't perform so well, I'm hopefully still going to get somewhere in the 20% range. That's how I incorporate a margin of safety. Now, the multiple I could sell it for with these growth rates is of about a 15 times free cash flow. I've already put in the free cash flow numbers, the shares outstanding, the cash, and the debt. It tells me I want to buy this at about $175. Now, the current share price, if we go have a look, is, wow, it's $600. So this is way overpriced in terms of what I'm trying to achieve. Now, let's put this discount rate down to, 22%. I don't want to go much worse than that. Maybe I'm going to aim for somewhere between like a 15-20% return on my money. That's not for me, maybe that's for you. So I'm just going to show you what it looks like. And let's increase these growth rates, because that return on invested capital was really good. Let's give them the benefit of the doubt, and they can grow at, 25% for the next 5 years, and then 15% for the year after that. This is wildly optimistic, way above what the analysts think. And I've got a lower discount rate now, and it still tells me I really should be only buying this at about $400. Stock price is $600. This is seriously overpriced. So I don't know how low we have to go here, but let's go back to my original numbers, 15 and 10% growth rates. Okay, that's a discount rate of 10%. So it's right on fair value. I would say it's probably slightly overvalued because we have no margin of safety here. Yeah, there's no value here at all. You're not going to get fantastic returns here. I would say the upside is minimal and the downside is significant. That would be my concern with this investment. So let's now turn to my opinion overall for this. So again, they have amazing metrics. That return on invested capital is fantastic. Great financials overall. Couldn't find any super investors, so that was a bit of a red flag. This is a good, solid company at a fair price, but without a margin of safety. I would need it to fall at least 50% before I even got interested in digging into this further. Look, maybe there is something hidden in this company, so something that I can't see, and I'd only find out if I dug deeper into it. But without the super investors invested in it, I doubt there's something hidden that I'm missing here. I just think it's really only at fair value, even if a little bit over fair value at the moment. And there you go, that's my opinion. Now, I hope you enjoyed today's video. If you do actually get any value out of the video, make sure to hit that like button for me so I can get some feedback, and I will see you in the next video.